For 70 years, Japanese companies quietly owned each other. Not as investments. Not because they expected dividends. They owned each other as a statement of loyalty. A silent, expensive handshake that said we are family, and family doesn't sell.
Banks owned car makers. Insurers owned their biggest clients. Suppliers owned slices of the manufacturers they served, and none of it moved. The shares just sat there, generation after generation, like heirlooms in a vault.
At its peak in the late 1980s, these permanent shareholdings accounted for somewhere between 60 and 70% of the entire Tokyo Stock Exchange by market capitalization. More than half of Japan's stock market was, in a meaningful sense, not a market at all. It was a web.
They called this system Keiretsu, and for a long time the West looked at it and saw only the defects, the opacity, the insularity, the way it locked out foreign competition and made hostile takeovers effectively impossible.
But here's what the West missed: Keiretsu wasn't just a financial structure, it was a philosophy. The idea that stable relationships, not quarterly returns, were the foundation of business.
Now that philosophy is being dismantled. Not by foreign pressure, not by activist hedge funds, by a used car dealership in suburban Japan.
This is the story of Keiretsu, what it was, how it worked, why it survived for 7 decades, and why a fraud scandal involving inflated auto body repairs broke open $60 billion worth of ties that were supposed to last forever.
To understand Keiretsu, you have to go back to the years just after World War II. Before the war, Japan's economy had been dominated by zaibatsu, giant family-controlled conglomerates with names like Mitsubishi, Mitsui, and Sumitomo. Think of them as Japan's version of the Rockefeller trusts, except concentrated across every industry simultaneously: mining, banking, shipping, chemicals, textiles, heavy industry, all under one roof, controlled by one family.
The American occupation forces dissolved the zaibatsu in the late 1940s. The families were stripped of their shares. The conglomerates were broken up. From the outside, it looked like the end of Japan Inc.
It wasn't. By the early 1950s, after the occupation ended, the old zaibatsu members began quietly reconstituting themselves, but in a new form. There would be no family control, no single holding company at the top. Instead, the companies in each group would own small slices of each other. You own 2% of me, I own 2% of you. The main bank of the group would anchor the whole arrangement, holding stakes in all its members and standing ready to rescue any of them if they hit trouble.
This was the horizontal Keiretsu. Mitsubishi Bank sat at the center of the Mitsubishi Group, alongside Mitsubishi Corporation, Mitsubishi Electric, Mitsubishi Heavy Industries, and dozens of others. Sumitomo Bank anchored the Sumitomo Group. Mitsui Bank, the Mitsui Group. The presidents of all member companies met monthly, gatherings called shachokai or presidents' councils, to coordinate strategy, share intelligence, and reinforce the bonds of the network.
Alongside the horizontal Keiretsu grew the vertical Keiretsu, the supply chain alliances. Toyota didn't just buy parts from suppliers, Toyota owned stakes in them. Denso, Aisin, Toyota Industries, all partial Toyota subsidiaries, all bound into a web of mutual obligation that ensured quality, absorbed risk, and aligned incentives across the entire supply chain.
This was, in many ways, a brilliant solution to a specific post-war problem. Japan had been bombed flat, capital was scarce, trust was in short supply. The Keiretsu system allowed companies to access cheap financing from their main bank, stabilize their supplier relationships, and protect themselves from hostile takeovers by ensuring that the majority of their shares were held by friendly hands who would never sell.
And it worked. Through the 1960s and 70s and into the 80s, the Keiretsu groups were engines of Japan's economic miracle. The companies within them could invest for the long term without worrying about quarterly earnings pressure. They could absorb short-term losses to maintain relationships. They could coordinate on technology without the transaction costs of arm's-length contracting.
By Chicho by Bashibashi, cross-shareholdings represented approximately 60 to 70% of TSE market capitalization, according to Nomura Research Institute estimates. For context, if you bought an index fund of the Japanese stock market at the peak of the bubble, more than half of what you were buying was shares that nobody intended to ever trade.
Then the bubble burst. Japan's asset prices collapsed in Senchu 5 Fuis and Senchu 5 Fui Eden. The Nikkei fell from nearly Sanwanchu Sen to below E11 within 2 years. Real estate prices fell by half, then by 2/3. Banks that had been lending against inflated collateral suddenly had balance sheets full of loans they couldn't collect.
The first Keiretsu shares started moving. Banks needed to raise capital, some holdings got sold. The system began to slowly unravel.
But slowly is the key word. Between Senzubagoshi and Mercedi worth 32 years, the broadly defined cross-shareholding ratio fell from roughly 70% to about 25%. That sounds significant until you do the math. It works out to roughly 1.5 percentage points per year. At that pace, the system would take another 15 years to fully dissolve.
The Keiretsu was dying, just very, very gradually. Then came Big Motor. Big Motor was not a famous Japanese company. It was a used car dealership, the country's largest independent, with about 100 locations across Japan and revenue of around 800 billion yen, roughly $5 billion before its collapse.
In the summer of Refriore, Fusselblower sent a document to Japan's 3 largest non-life insurance companies. The document alleged that Big Motor had been systematically damaging customers' cars at its repair shops, scratching paint with wire brushes, puncturing tires with golf cleats, deliberately breaking parts, in order to inflate insurance claims. If a car came in needing a Refriore fizzer, Big Motor might run up Hasendor in unnecessary work and submit the whole bill to the insurer. The insurers paid. Big Motor booked the revenue.
Tokyo Marine and MS&AD Insurance, 2 of the 3 recipients of the whistleblower tip, commissioned independent third-party investigations. They found serious problems. They reported those findings to regulators.
Sompo Japan did something different. Sompo Japan had a unique relationship with Big Motor. The insurer had approximately 40 of its own employees embedded inside Big Motor locations, helping the dealership sell Sompo insurance products to customers who came in for repairs. The relationship was, by any objective measure, a classic Keiretsu arrangement, a cozy, mutually profitable tie built on personal relationships, cross-referral of business, and a shared understanding that you don't ask hard questions of a partner.
When Big Motor conducted its own internal investigation and cleared itself of wrongdoing, Sompo Japan accepted the result. As the Financial Services Agency noted in its October Nisen report, Sompo Japan had reason to believe the internal investigation was inadequate, but declined to press further because the business relationship took priority.
In January, after months of regulatory pressure, Sompo Holdings, CEO Kengo Sakurada and President Jichi Shirakawa both resigned. It was the highest-profile corporate governance failure in Japan since the Olympus scandal.
But Big Motor was just the beginning. Simultaneously, Japan's Fair Trade Commission was investigating the same 4 non-life insurers, Tokyo Marine, Mitsui Sumitomo Insurance, Sompo Japan, and Ioi Nissei Dowa for coordinating insurance premiums for large corporate clients.
Here's how it worked in Japan. Major corporate insurance policies are often structured as co-insurance arrangements, where multiple insurers share a large risk. When bidding for these contracts, the 4 companies had been quietly coordinating who would serve as lead underwriter and at what price, essentially eliminating competition among themselves.
The coordination happened, in many cases, along the lines of existing business relationships. You insure the companies in your Keiretsu group, I insure mine. We agree on pricing in advance so neither of us has to actually compete. The Fair Trade Commission issued cease and desist orders and fines totaling approximately 14 billion yen, roughly $92 million, in October, Ni-Ni-Not Yuthin, covering cases including bids for Tokyo Metropolitan Government Hospital Insurance and Sendai International Airport.
The Financial Services Agency's conclusion was blunt. The cross-shareholding arrangements between insurers and their corporate clients were not just cozy, they were institutionalizing anti-competitive behavior. The equity ties were the mechanism by which collusion was organized and sustained.
In February, insurers, Japan's non-life insurance industry announced what would have been unthinkable a year earlier: insurers must cut cross-shareholdings to zero.
The three major non-life insurers disclosed how much they held. The number was staggering. Tokyo Marine Holdings, MS&AD Insurance Group Holdings, and Sompo Holdings had a combined 6 trillion yen, roughly $40 billion, in cross-shareholdings accumulated over decades. All of it was now a liability.
They set timelines. MS&AD committed to full elimination by March. Nissenjiften Sompo set a target of March. Nissenjiften Tokyo Marine moved fastest. By February Nissenjishruv, the three companies had already sold approximately 10 trillion yen, roughly $11 billion, ahead of their own targets.
But the insurers were only the most dramatic example of a broader regulatory push that had been building for 2 years.
In March, the Tokyo Stock Exchange had launched what it called a management that is conscious of the cost of capital and stock price initiative. The impetus was a disturbing statistic: nearly half of all companies listed on the TSE Prime market traded below book value, meaning the market valued them at less than the accounting value of their assets. In comparison, only about 3% of S&P WOJIP companies trade below book value.
The TSY identified cross-shareholdings as a major cause. When a company holds 3 trillion yen in the shares of its business partners, that capital is not working. It generates low returns. It suppresses the company's own return on equity. It makes the company look cheap on valuation metrics, which then makes it a target for activist investors. And if the activists break through, the whole web of stable relationships comes under threat anyway.
The TSE's message to companies was direct: explain why you hold these stakes or sell them. By March, Nasha's WUV, more than 90% of prime market companies had filed formal disclosures of their cross-shareholding rationale. For many of them, the exercise of trying to articulate why they held shares in a company they'd had a business relationship with for 40 years and coming up with no better answer than we always have was itself the beginning of the end.
The most symbolically significant break came in June. Mitsubishi UFJ Financial Group and Sumitomo Mitsui Financial Group, Japan's two largest banks, the main banks of the Mitsubishi and Mitsui Keiretsu respectively, announced they would sell approximately 1.3 trillion yen worth of Toyota Motor Corporation shares. That's roughly $8 billion in Toyota stock, from the two banks most closely associated with the industrial alliances that defined post-war Japan.
Toyota, for its part, announced it would facilitate the transition with an 80 billion yen share buyback, about $1 billion, buying the stock directly back from banks and insurers. MS&AD Insurance tendered 79 million of its -14 million Toyota shares back to the company.
To understand the magnitude of this, you need to understand what Toyota represents in the Keiretsu ecosystem. Toyota isn't just a Keiretsu participant. It is in a sense the most successful practitioner of vertical Keiretsu principles in history. The Toyota production system, just-in-time manufacturing, Kaizen, all of these innovations depend on deep, trust-based supplier relationships that Keiretsu equity ties helped sustain. When the banks that anchor the horizontal Keiretsu system start selling Toyota shares, it's not just a financial transaction, it's a signal about what kind of corporate Japan we're entering. Janice Henderson, commenting on the announcement, called it Toyota's bold move marks a new era in Japanese corporate governance, and for once that kind of language doesn't feel like hyperbole.
What happens to $60 billion when it stops sitting in a vault? The answer, in Japan's case, has been two things: share buybacks and mergers and acquisitions.
In fiscal year R-sen-C, Japanese companies bought back a record 16 trillion yen of their own shares, roughly $106 billion. That's not a marginal change, it's a structural shift in how Japanese companies allocate capital, driven in large part by the proceeds from unwinding cross-shareholdings. Companies that previously locked up capital in strategic equity stakes are now returning it to shareholders.
On the M&A side, the numbers are equally striking. According to VCI Institute research, Japan's M&A market hit a record Nikkei 32 billion in the first half of 2022 alone. Private equity firms that had previously found it nearly impossible to acquire Japanese companies because stable shareholders would never sell are now finding targets in abundance. Bain Capital, KKR and EQT have all made significant moves in the Japanese market in recent years. Trend Micro, the Japanese cybersecurity company, has been in discussions about a potential take-private deal with foreign PE firms.
7i Holdings sold a 150 billion yen portfolio of non-core assets to Bain Capital. The Keiretsu system, at its peak, made Japan largely uninvestable for outside capital. The unwinding is making it one of the most active M&A markets on Earth.
Here is perhaps the most remarkable statistic in this entire story. According to Nomura Research Institute analysis, purely profit-seeking investors, shareholders who actually want returns, who will sell if they're unhappy, who will push back on management if performance lags, represented just 25% of the Tokyo Stock Exchange by market capitalization in fiscal year Sen-Chuvak-Fasjalukdan.
By fiscal year 2023, that number had risen to 59.9%. For the first time in the modern history of the Japanese stock market, more than half of its shares are held by people who are actually trying to make money.
That sounds like an obvious, unremarkable thing. But in the context of Japan's financial history, it is genuinely revolutionary. For most of the post-war period, the majority of the Japanese stock market existed in a kind of suspended animation, held by entities that were not trying to maximize returns, that would not sell under normal market conditions, that evaluated their holdings not by financial metrics but by relationship quality.
The Keiretsu system created a market that was structurally not a market. Its unwinding is creating a market that actually functions like one.
This brings us to the Japan factor in all of this, the thing that makes Japan's experience different from a simple story of corporate governance reform.
In most Western markets, when institutional arrangements that entrench management and suppress shareholder returns persist for decades, the mechanism for change is external. Activist investors show up, accumulate shares, file proxy proposals, pressure boards in public. Change comes from the outside in.
Japan's Keiretsu unwind has been different. The pressure came from regulators who are themselves Japanese. The Tokyo Stock Exchange's cost of capital initiative was designed and launched by the TSE itself, a Japanese institution, staffed by Japanese people, pressuring Japanese companies. The financial services agency's response to the insurance scandal was vigorous domestic enforcement, not the response to foreign pressure. The insurance industry's pledge to zero out cross-shareholdings came from within the industry association.
This is Japan reforming itself on its own terms, at its own pace, and the pace is, by historical standards, fast. Cross-shareholdings that declined by roughly 1.5 percentage points per year for 3 decades are now being eliminated 3 times faster than before. Nisantain. The 3 major non-life insurers, which collectively disclosed $40 billion in cross-held shares just 2 years ago, will have them gone by Nisantain. There's a second element to the Japan factor here, and it's the one that deserves the most attention. The Keiretsu system survived for 7 decades in part because it delivered real benefits, not just to the companies involved, but to Japan's broader economic development. The main bank system provided capital to companies that the market alone might not have funded. The vertical Keiretsu supply chains produced manufacturing quality that the world still marvels at. The stable shareholding base protected companies from the short-termism that has plagued Western corporate strategy.
The system didn't fail because it was always wrong. It failed because the conditions that made it right, scarce capital, underdeveloped financial markets, low corporate governance standards, are no longer Japan's reality.
Japan's stock market is now the 3rd largest in the world. Capital markets are deep and liquid. Corporate governance standards are rising rapidly. The protective logic of the Keiretsu has given way to the opportunity cost of the Keiretsu. $60 billion sitting in someone else's stock when it could be driving your own returns.
The question that remains is what replaces it. The Keiretsu system wasn't just a financial arrangement, it was social infrastructure, the monthly president's councils, the implicit understanding that if a member company hit trouble, others would help, the long-term supplier relationships that allowed manufacturers to share technology and co-develop products without elaborate contractual protections. All of that was held together by the equity ties.
Some of it will be replaced by formal contracts, some by market relationships, some by the M&A boom. Companies that were once Keiretsu partners may become actual subsidiaries, with clear ownership rather than implicit alliance.
And some of it may simply not be replaced. According to McKinsey analysis of Japan's valuation gap, the Keiretsu's constraints on capital allocation were a significant driver of the persistent gap between Japanese and Western company valuations. As those constraints dissolve, the gap should close. The Nikkei crossing Lukumen for the first time in April Nisen Nisluk, driven in part by earnings growth from companies newly focused on capital efficiency, is early evidence that the calculation is changing.
The real test will come when Japanese companies face their first real hostile takeover battle in the new environment. Without stable shareholders to call on, without the main bank backstop, a Japanese company with poor governance and a low price-to-book ratio will be exposed in ways that weren't possible before.
That may be exactly the point. The architects of Japan's reform understand that the final enforcement mechanism for capital discipline is the market itself, and for the market to work, shares have to be in the hands of people who might actually sell them.
For 70 years, Japan chose corporate kinship over shareholder capitalism. The choice was deliberate, and in its time it worked.
Now Japan is choosing differently, and $60 billion worth of permanent shareholdings steadily hitting the market is the evidence that this time the choice is real. Word count Nisen Hesed Bitheriun speed words estimated duration Monis